The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. Welcome to tonight's mentoring event from the SMSF Club. I think the time has just ticked over, so we'll get underway straight up. Thank you for taking time out of your busy schedule to tune in. I know leading into Christmas, even though we're still in the early days of November, it's a very busy schedule for everyone, especially families as schools closing or slowly approaching the end of the year. And look, a lot of people, a lot of clients seem to think that they don't need to tune in to new investments or tune in to market updates. But look, when we look at the investment universe, when we look at the superannuation rules, when we look at the self-managed super fund market, as time and time progresses, I think we all need to ensure that we're educated, informed about the changing economic environment, the changing investment landscape, and the changing rules that govern not just self-managed super funds, so superannuation as well. So look, I respect and applaud each and every one of you for taking time out of your busy schedule for tuning in. As always, look, tonight's presentation is general advice only. That means that I haven't considered your individual circumstances when I've put together this presentation. I'm going to go through a few scenarios and hypotheticals, and when I've made some assumptions, I'll make sure I let you know those when we're talking about it throughout the presentation at the time. Past performance is an indicator of future performance, and when we are talking about previous performance, I'll let you know at that time. The SMSF Club, we're licensed through a group called RM Capital. I'm licensed to provide, and the company's licensed to provide both personal and general investment advice. Many people, most clients take general advice as the service offering because they just want to be educated. I suppose as a self-managed super fund trustee, that is your obligation, right? Your obligation as a trustee is to make informed, compliant investment decisions with the superannuation assets that the members of your super fund have trusted you to take care of. Those members with the self-managed super fund are generally yourself, so it's pretty critical you do the right thing. It's not just the compliance, it's also your retirement that's at stake after all. But look, if you do want personal advice, if you do want advice where we as a company or your individual advisors around the country, if you do want them to take into consideration your personal circumstances and give you direction as to where to invest your money based on your personal circumstances, then we're happy to provide you with what's called a statement of advice or retirement financial plan. So speak to your advisor if that's something that you'd be interested in doing. It's a service that we've added over the last 12 months to our product offering. Okay, look, tonight's webinar we're going to be covering a few things, but the first thing that I wanted to launch is my board game, Diversification. It's finally been put together. It's something that I've been working on for a good decade, and many of you may have played it. I think it was mid last year we went around the country in our mentoring nights where we had them in all states and we played the game. We've modified the game since then and we are actually officially launching it to the marketplace. So it's a great Christmas gift idea for your family, your children, for your broader family. I know a lot of people talk to me each and every day saying, hey, we've got these friends that are looking at setting up a self-managed super fund. They're not too sure where to start. They're a bit apprehensive. They don't know how to invest. Well, look, the best gift that you can give anyone is a gift of education. That's one of the things that's motivated me to put together the board game. And look, I think it's the greatest gift that you can give anyone else. And that is an education when it comes to investments. We're not taught it at school. Our children aren't taught it. I think the majority of us growing up, I was a little bit different, but I certainly was involved with the board game Monopoly. The majority of people have had their lessons taught to them by playing Monopoly over and over again. And no doubt your household was similar to mine in that you end up with a fisticuff with your brothers and sisters or your parents over who was the banker, who was cheating. So this game is similar to to Monopoly in that it's aimed at teaching you about broader investment principles, not just getting a fight with your siblings. So look, and also the biggest thing I think the aim of the board game is to teach people how the benefit of compound interest is such a powerful and interesting investment tool over time. But generally speaking, a lot of people that come and sit down with me, they wish they started a self-managed super fund or taking investment serious earlier. Unfortunately, it's not a lesson that you can learn too late. What it relies on is time. So it's not something that you can make a mistake on, because if you make a mistake on compound interest, when you understand it, it's often too late to implement. So we need to start learning these things at a younger and younger age, and that's why I put the board game together. That's $79 plus postage and handling for SMSF Club clients. All profits that's generated from the board game is going to produce more board games. My goal is to put it in every school in Australia. Every high school is a starting point. There's around 3,000 high schools. That is my goal, and not just one board game, but a few. I'd love to win the Guinness Book of Records for the most amount of people playing a board game simultaneously. That record stands around 2,500 people, which is a Japanese board game like backgammon. I think we can do that with a school competition where we run it Australia-wide. It wouldn't take much for us to break that world record, but more importantly, to teach thousands of school kids the importance of taking a long-term view, the importance of working hard and saving, not spending more than they save, and to invest for the long term. That's the idea of the board game. It's fun. If you played it when we played around the countryside, we had a great time by putting it together. So yeah, buy the board game. If you're interested in the board game, email admin@thesmsfclub.com.au. Send me an email, speak to one of the advisors when you're talking to them, or just put your details in the question section, and I'll get the details out as to how you can go about buying the board game and get it before Christmas. So you might not just buy it for yourself, but buy it for every family member you've got. That would be superb. A great way to contribute back to education for future generations, hopefully. The webinar agenda, I'm going to go through a few things. Going to go through the key 2018 SMSF statistics, commodities as an asset class, self-managed super fund, modern portfolio theory, the tailored investment solutions, and new gold investment, and why I've launched that. So self-managed super funds, the latest statistics. Actually, one statistic that isn't in here that I found interesting is that the majority of Australians, have more money on credit card debt than they do savings. Now, there is an age group. I don't want to make a broad statement like that. There is an age group. I just don't know the age group. I don't have that figure in front of me right now. But let's just assume it's under 30. I don't know what age group it is, and I'd imagine it'd be the younger generation. But we have more debt in credit cards, where we're paying, I don't know what credit card debt is interest rates are these days. It's probably 15 to 20% for the majority of us. More money on credit card than we do savings. That's an interesting situation, and it's a harmful situation for not just those as individuals, but the broader economy, as we all become more and more consumed with more and more debt. And that's not just at a credit card and personal level. It's becoming more so at a corporate level. It's becoming more so at a government level, not just here in Australia, but across the world. And I'll talk about that across the presentation tonight. But on a positive, self-managed super funds. The latest statistics from Class Super. Class Super are the biggest software provider in the self-managed super fund accounting and administration space. They've come out and shown that self-managed super funds, the return on assets and the rate of return have been higher for self-managed super funds than the industry and the retail other super funds. So not that it's been high. If we look at the 5.59% as the return on assets, the average return on assets, that's not huge, right? But when the external APRA regulated funds is below 5, at least self-managed super fund trustees are outperforming the counterpart. The rate of return slightly higher at 6.71% for self-managed super funds. So it's good to see that self-managed super fund trustees continue to outperform the so-called professionals that are paid a heap for underperformance. So self-managed super funds are still performing very, very well. That's over a 10-year period, that average rate of return. The number of members in a self-managed super fund sits at 1.9 people, which would be consistent across the SMSF Club. If we look at the breakdown of the number of self-managed super fund trustees and members, 21.6% have one-member funds, 70%, close to 71%, are two-member funds, and that would be pretty consistent here across our company, as most people, husband and wife, have a self-managed super fund together. What is interesting is 3.6% of self-managed super funds are three-member funds and 3.9% have four. So 3 and 4 member funds is very little, right? You combine them, you're less than 8%. And it's interesting, the ATO and the government, I think they may have actually already introduced it. I can't recall whether they've introduced it or it's about to be passed, but they want to increase the maximum number of self-managed super fund trustees from 4 to 6. Now, for me, that just creates further and further headache. There's more and more people that need to be brought together to make collective investment decisions. And God forbid one of those people that are outside, a family member, says no to an investment, it means the entire self-managed super fund is pretty much hamstringed, tied behind your back, your arms tied behind your back, because you can't move forward. So I don't think 5 and 6 member funds are going to be very popular. In fact, if you look at those stats, 3 and 4 member funds aren't very popular already. So I know I scratch my head at some of the proposed changes that the ATO and the government look at putting forward. Average member balances in 2 member funds, the first member 857 grand, and the second member 473 grand. By gender, 52% are male trustees or members, and 48% are female. Average member balance by gender, males are still 22% higher than females. Now, the reasons for that are, one, women generally spend a bit of time out of the workforce to have kids or to look after elderly parents and things. That's one of the reasons. But unfortunately, even where we are today, despite the advancements in gender equality in the workforce, women are still paid less than men, and that is rubbish. But hopefully we're getting closer and closer to more gender equality in the workforce. When we're looking at where self-managed super funds are being invested, if we look on the left side, 28% are listed shares. So the largest component of self-managed super funds assets are being invested in shares. If we looked at that closer, most are banks, most are Telstra, there's a few Woolworths and Wesfarmers as the top 10 investments held in self-managed super funds as a broad spectrum. BHP, Rio would be up there as well. 20% is held in cash, term deposits. Now, that is so alarming, and I scratch my head completely at the amount of people, even in our client base, that have so much money sitting in cash. Even if you've got 20, 30, 40 grand, you've got to scratch your head and go, what am I doing with so much money sitting in cash? Because right now, the interest you earn at Macquarie Bank is less than inflation, well less than inflation, which means holding money in cash is the riskiest asset class you can hold money in. With interest rates at 50-year record lows, and in today's newspaper, they're speculating that the next move in interest rates here in Australia could be down, not up. Having money in the bank account is the silliest place to have it invested. It is the riskiest because it's not even keeping up with the purchasing power of inflation, right? So if you take anything out of this webinar, go look in your Macquarie bank account and see how much money you have sitting in cash. You'll be surprised at how quickly it grows with contributions, investment dividends, rental income, other returns that are going into the fund. So chances are you're sitting on a bit of cash that you probably would look at investing elsewhere to ensure your retirement goals are achieved. 20% would be probably a fair indication of our broader client base. Some have 100% of their money sitting in cash, right? And they've been doing so for 3 or 4 years. That's rubbish, right? I don't think they're performing their duties as a trustee. They're not meeting their obligations to having it allocated by sitting in cash for such an extended period of time. And if you're sitting in cash for no real reason, you're not doing your responsibilities as trustee either. So look at how much money you've got in the bank account. Sit down with other trustees and talk about, well, how do you go about investing it? Where is a better place to have it invested? Unlisted trust, actually, if we go down fourth on the list, non-residential real property, 9.7%. What that refers to is business real property, commercial, where it's owned directly by the self-managed super fund. I want to compare that number non-residential real property to residential real property. So business real property, commercial property is 9.7%, and residential property still sits at 6.2%. It's bugger all, right? It's one of the smallest asset classes that is held in self-managed super funds. If we go further down the list, the second from the bottom, limited recourse borrowing arrangements, 3.5%. Now, every day I hear the government or someone at either spectrum of government, some different inquiry, some so-called specialists come out and say that they're concerned about the amount of borrowing self-managed super funds are getting themselves into. Yet, when we look at the real statistics, less than 3.5%, well, 3.5% of the total self-managed super fund assets are held are actually borrowed money, borrowed funds. It's 2/5 of bugger all. So we should be focusing on more things rather than going, hey, getting into debt is risky when you can borrow 70% on an investment property, and start looking at, well, hang on a minute, how can people actually mitigate risk, enhance returns, and hopefully achieve their retirement goals? Looking at making it easier for that to happen rather than adding more and more restrictions. And for the last 3 years, all I've heard about is restrictions for self-managed super funds, especially when it comes to borrowing money. Sure, you borrow money and buy a crap investment, it's going to produce a crap result, right? A very crap result because it's going to be magnified. So when you borrow money to buy an asset, inside a super or outside a super, you got to make sure it's a very good one. So do your due diligence before you invest in any asset, especially if you're going to borrow to fund it. It's going to be magnify the returns on the upside, but also magnify them on the downside. But for me, look, you've chosen to become a trustee. You've got to make smart investment decisions and be accountable for the result. Not go, yeah, I invest in it, and then 5 years down the track, I lost a bit of money because rental income's gone down or it's been vacant for a month or two. You made that investment decision. You're the trustee. Be accountable for it. Learn from it and look at how you move forward. Any asset that you're buying inside a super, whether it's property, whether it's gold, whether it's shares, it should be held for the long term, because after all, when you need the money from retirement, it's probably going to be after a long period in retirement. That's my rant on the latest SMSF asset allocation statistics. This isn't really a snapshot of what you should be doing. I'm not a believer in following the herd. I don't believe just because the average self-managed super fund has 28.1% invested in listed shares, you should go out and adopt that. I'm a big believer in sticking to what you know and look at reducing risk or outsourcing it to experts in other areas. But look, if you stick to what you know, you should have more experience. You should be able to make better and more informed investment decisions moving forward. What SMSFs are investing in, if we look at the right, 100% of all self-managed super funds obviously have money in cash. You need money in cash. If not at all, at a minimum, it's to pay me. It's to meet insurance. If you've got insurance in your super fund, it's to meet the other cash flow requirements like paying ASIC, paying the OTO. So everyone needs a bank account in a self-managed super fund to act as a hub. 65% of self-managed super funds by way of numbers have invested in direct shares. 31% managed funds. Not too sure why people invest in managed funds. 30% direct property. As we can see, the majority of that is business real property. Debt securities, 20%, ETFs, 20%. That's where I think it's probably going to be the biggest growth area for self-managed super funds, exchange traded funds. If you want to know more about ETFs, log into our mentoring library. I think it was about 6 months ago, we did a mentoring webinar on exchange traded funds and the evolution of that. I do think ETFs are going to be a big player, not just in the self-managed super fund market, but the overall investment market for many years to come. Direct international shares, 6%, collectibles, 1%, as you'd expect. Economic update. So where to from here? The economy. Where are we at? Well, first and foremost, we have to look at where we've come from over the last 10 years. If we go back 10 years ago, pretty much to the day we had the global financial crisis. Was it November 2007? I think it was the high of the global share markets before we had a few months later Lehman Brothers go broke and the collapse of the United States banking industry, followed by the collapse of the US share market, the collapse of many areas in the US property, followed by global share market falls in pretty much every country around the globe. 10 years on, we've had a very strong 10-year bull market in the United States. Many of you have enjoyed the profits from that by investing in the Tailored Investment Solutions Berkshire Hathaway investment. The last 10 years, our Berkshire Hathaway investments have average return around 90% over a 3-year holding period, which has been a phenomenal rate of return. So we've ridden the upside of the US growth by investing in Warren Buffett's company, right? It's been a phenomenal performer. If you look at the Australian property market, the Australian property market does work in different cycles in different cities: Perth, Melbourne, Sydney, Brisbane, Newcastle, Adelaide, Tasmania. They have all different microeconomic drivers in those areas. But as a broad spectrum, we've had, if you go back 10 years ago, we've had some pretty good, healthy profits in the property sector overall as a general statement. Some sectors like Sydney has performed better than others. Others performed better, like the first 5 years of the last decade, like Perth. The last 5 years, probably Sydney has performed better. Melbourne has performed differently at different times. Now, I'm not a property expert, but look, growth assets, whether it's shares or property, have had a very stellar run over the last decade. The only exclusion to that is the Australian share market. While 10 years ago, if we look at the benchmark from where it was pre-GFC, our Australian share market needs to go up a long way before we get back to those highs, which is almost 30-40% that needs to go up just to get back to those levels that it was pre-GFC. However, if we go forward to the bottom of the GFC, we're up about 60%, which is good, but still a long way from where we were previously, and we're still lagging behind the majority of the share markets around the globe. So the Australian share market has been very frustrating over the last decade with plenty of ups and downs. And for me, I pulled my hair out. I'm thankful I had that Berkshire Hathaway investment, which has provided a pretty good return in my portfolio, which has offset, I suppose, slow returns in the Australian share portfolio of mine. So that's the last decade. We've seen interest rates plummet. We've seen interest rates in the United States start to head up again. As their economy has grown and they're starting to see economic growth, and they're a bit concerned about inflation. However, you look at global growth assets, where we are now is an interesting environment. We're certainly existing in volatile times, not just here in Australia, but also in the United States. One day, 2 weeks ago, I looked at the newspapers and some of the headlines read, "Global growth uncertainty." Global markets, I suppose in October, was pretty frightful. There was a fair amount of fear in the market. And the tumble took, the world global index just for the month to a loss of 7.2%. So the index, which is called the FTSE All World Index, which is sort of a benchmark about global share markets, that fell 7.2% in Australia, which is its worst performance pretty much in the last decade, I think since 2012. So look, there's a few things that I suppose that has led to that global uncertainty. People are worried about the climbing US interest rate environment, bond yields in the United States, and what that's going to have an effect on the world's biggest economy, the United States. We've got China concerns. China growth is slowing, probably at a quicker rate than most people were hoping for, as look, the market's trying to, or the Chinese are trying to create a soft landing in their overall economy, which generally doesn't happen when you have such stellar growth that China experienced a decade ago. US earnings volatility, there's been some ups and downs. Like general speaking though, US earnings has been quite good. I just think that the market factored in that they were going to be outstanding. So there's been a bit of volatility as people are looking at and asking themselves the question, is this as good as it's going to get? We've had low interest rates. We've had quantitative easing. They've been printing a lot of money. We've had tax cuts. Because of all that, people looking at it, at the share market and companies' profits saying, look, can they get any better than the current environment than we've got? And that's a great question. It's a great question that economists are asking themselves. I'm asking myself that, especially in global markets, is this as good as it gets? Because they've had pretty favourable environment in the United States for a long period of time. What we've got, trade tension, risk of rising inflation, with interest rates at or record lows for a long period of time. I'm dumbfounded that over the last decade inflation has been quite low, especially in the United States and here in Australia. That's the first time in recorded history that we've had such high cuts in interest rates without having a flow-on effect to high inflation. But look, moving forward, inflationary figures look like they're actually increasing, which is a concern for global growth. Trade tension, especially between the United States and China, as Trump is leading the pro-America policy. That trade tension, when the two global heavyweights are going into bat against each other, toe to toe, throwing haymakers, that's obviously creating a fair amount of uncertainty and could create further share market weaknesses. Rising interest rates in the United States. Here in Australia, look, I read an article today that they were expecting that interest rates are going to be cut, which is the first time I've read that in a long period of time. While many people get excited about cuts in interest rates, I'm concerned about that. If they're talking about cuts in interest rates, that means that the economy isn't performing as well as we would hope. So they need to stimulate the economy by cutting interest rates. One of the main ways the RBA influences economic growth. Political dramas. Look, I'd like to think that we've got here in Australia a stable political environment, but over the last decade, I think we're up to 7 prime ministers. It doesn't seem to think that, I don't seem to think that Australia is, in fact, a stable political environment at all. I think there's a lot of international businesses that are looking at the changes at the top and thinking that they'll invest elsewhere rather than here in Australia because of that political uncertainty. And I expect as more and more politicians get worried about monthly poll numbers and the latest stats coming out about popularity of a PM, I think that the politicians saving their ass and hoping to get re-elected so they stab their prime minister in the back, I don't think that's finished anytime soon. Expect it to be continued for quite some time. Political drama, not just here in Australia. We've got the Trump effect. While Trump lost the House of Representatives, I think that's a good thing for the United States. We saw over the last few days last week when the midterm elections went through in the United States, the US share market and here in Australia had a bit of a rebound despite last night and today. So I think that creates a little bit more security in the United States about political power. Here's a snapshot from the Australian Financial Review, just 5 minutes before we started. I inserted this slide. This is the front page of the FinReview website. If we look at a few things that's revealed there, fresh wave of selling. What we got? There it is. A renewed wave of heavy selling slammed the ASX as technology and healthcare stocks fell sharply. I think that was also technology stocks, banking shares, the broader market. I didn't see too many green, which means the stock is up on my screen today. UBS reveals 5 worst case scenarios. So UBS is a global investment bank. The Economist, that's quite well respected, came out with 5 different predictions as to what could happen. If I read a little bit of the article which I've got in front of me, recession, house prices collapse, Aussie QE, quantitative easing, UBS's nuclear scenario. UBS has unveiled a new worst-case scenario for the Australian economy, including the first recession in 27 years, a 30% collapse in house prices, and widespread litigation against the banks for mortgage mis-selling. Talking about the Reserve Bank cutting interest rates to 0 before embarking on its own version of quantitative easing. So, look, that's in today's paper. All of those things is a concern. The Australian share market fell by almost 2% today, which wiped 32 billion off the overall market capitalisation of our share market. So just today, you look at those headlines. Look, I very rarely look at the noise in the media and base investment decisions of it, but on the back of 10 years of global growth, especially led by the United States, it'd be very silly for us as an advisor, it'd be silly for you as a trustee to ignore these and do nothing about it. I think we do need to prepare ourselves for the slight chance that, look, these concerns flow on to a big effect on the downside at GFC Mark II. A property collapse of 30%, I hope not. I think it's highly unlikely. But if we look at the overall property stats that have come out over the last few weeks in Sydney, Melbourne and Brisbane, clearance rates are falling at auction clearing rates to pretty low levels. An economist came out and they said the overall property market in Sydney fell by 7.4% over the last 12 months, which is a big fall in 12 months for an asset class that we thought was quite stable. So right now, things are uncertain, things are happening, and I think we should be alarmed. So let's look at what we can do about hedging our bets. Now, I don't think it's the time to sell off everything. I don't think it's the time to go, look, let's convert to cash, which is what some economists suggested. I think it was in yesterday's newspaper. If you convert to cash and you're wrong and markets to continue to have a huge rally, then you miss out on those gains. As I said, cash is the worst place to be invested. Generally, I'd say, hey, it's a long-term view, ride the ups and downs of the market, which I'm all for. I'm all for that. I'm all for maintaining a large portion of your portfolio to growth assets if that's where you've chosen to invest it. But we need to look at more than just diversification theory. What we need to do is go, okay, let's look at enhancing modern investment theory and see what we need to do, not just to profit if the global markets continue to have their rally, but what do we need to do for portfolio allocation to mitigate risk if everything fell, and not just to mitigate risk, but maybe to profit from a fall in if that occurs. So modern investment theory, diversification. Let's look at what that was. Harry Markowitz is the guy there, the photo on the screen. He invented modern investment theory, which came up with the theory that asset classes are generally uncorrelated. His idea of diversification is don't put all your eggs in one basket. If we're going to come up with a slogan for it, which is often used for the theory of diversification. So a broader sense, let's say, okay, you know what, if we go back to the 1950s when Harry Markowitz came up with the theory, even the 1960s, 70s, 80s, 90s, even early 2000s, diversification worked. It was a very good way to reduce risk. The theory of diversification means spread your assets across your money across the different asset classes available. And generally there's 4 asset classes available. Fixed income, bonds, cash, term deposits, property, whether it's commercial property, residential property, whether it's industrial, office, right, plenty of property, Australian shares, then international shares. They're generally the 4 main asset classes that historically made up modern investment theory. The idea of these asset classes being uncorrelated implies a lower risk investment if you've got your assets spread across those 4 different baskets. Now, some people have more weighting to Australian shares, international shares, and property, less to fixed income, depending on your risk tolerance. That's essentially how modern investment theory is flown on to advisory work. If you become more risky rather than risk adverse, your allocation to riskier growth assets like property, shares, and international shares increases. If you're more risk adverse, you get more investments in a fixed income, which is perceived as less risky. The idea of spreading it across different asset classes is to reduce risk. So back in 1952, generally, if the Australian share market crashed, property would go up in value. There was some occasions where if the Australian share market fell and there was a problem in the domestic economy, Australian property and Australian shares would perform exactly the same. So if they both fell, if you had your money spread across those 2 asset classes while it's diversified across property and shares, you would have lost money. So his view is that don't just limit your investments to one country, spread it across many. So if you invested in international shares, generally United States economy would work in different economic cycles to that of Australia. Now, this theory was 1950, well before the world becoming very, very smaller. The world has become very, very small, especially when we talk about trade, business, through the introduction of technology. Right now, we've got people that have tuned into this webinar that are in every state of Australia. We have clients in Queensland, Tasmania, New South Wales, Victoria, South Australia, Perth, and we have clients in Northern Territory. I'm not too sure if they've tuned in though. But they're across Canberra, ACT as well. So we're spread across all the way in Australia. And the only way we can deal business, I can speak to you now, is through technology, right? We are a technology firm, and if you're not a technology firm, soon you'll be out of business. Because of technology, the speed of travel, speed of communication, we've become one globe. What that has meant is that the majority of asset classes are correlated. As one global economy, if there's a problem in the United States, as we experienced in the GFC, it's going to affect your investments here in Australia, whether that be property or shares. It's going to affect your investments in Mongolia. It's going to affect your investments in London, Paris, South America, everywhere in the world, right? Because we are one economy. So the theory of modern investment diversification to reduce risk doesn't work, as underpinning all asset classes is essentially the same economy. The other thing that compounds it is underpinning all asset classes in the modern investment world, as I said earlier, is debt. And debt is consuming every asset class, whether it's individuals, as I talked about before, with credit card debt, whether it's property with residential property or commercial property. Underpinning most property is debt. If we look at shares, not just through margin lending, which is becoming increasingly more and more popular post-GFC as people forget about the downside risk of margin lending, but also the companies that you're investing in. I don't know of too many companies in the ASX top 200 or the globe that doesn't have a huge amount of debt underpinning their growth. If we look at the government, the United States, the one way that they've avoided such a prolonged economic recession or depression is because they printed a lot of money. So they've gone into a huge amount of debt. China is funding it through debt. Here in Australia, we're funding growth by debt. We are getting consumed by debt, and for me, that is a concern because we seem to be floating on an artificial economy that's funded by debt. One day, the day of reckoning is going to come where the people that are lending that money is going to ask for it to be paid back. So modern investment theory, diversifying across those four core asset classes in its own right, is not essentially reducing risk, right? Remember that. Modern investment theory relies on asset classes being uncorrelated. What that means is they perform in different cycles. Right now and moving forward, I think those asset classes are increasingly becoming more and more correlated as we become one whole economy, and underpinning everything is debt. The only difference to that as an asset class is gold. Now, gold for me in the past, over the last decade, I've been lucky enough to ride the growth of the US Australian share market and Australian property. And majority of you have only heard me talk about those three asset classes. A few of you invested in the Jim Rogers Ricky investment, which is fine. What we're looking at is more of a focused defensive asset, though, not something that's spread across energy and soft commodities and precious metals. What we're looking at is investing here in just gold. Now, gold still works in a different economic cycle to that of everything else in the world. There's no debt on gold, as it's generally perceived a non-productive asset. That is, you can't generate an income from it. So not too many people lend on gold in itself. Generally, it's perceived as a safe haven. So in times of economic uncertainty, people move their money from growth assets, being international shares, Australian shares, fixed income property, to gold because it's perceived as being secure. Okay, so the economic traits of gold are very different to the other economic traits of those other main asset classes. Now, look, the main guy that I know that is perceived as the gold guru across the world is Jim Rogers. I've been lucky enough to meet him a number of times, speak to him on a regular basis. a few years back when we put the investment together that was linked to his index. Jim Rogers is known as the commodities king. He's known as the gold guru. Just give you a bit of background, he set up the Quantum Fund with George Soros. George Soros is probably a more famous investor. George Soros continued to run the Quantum Fund, where Jim Rogers, after a period of time, retired and achieved a few other things in his world. He set it up in the 1960s. The Quantum Fund, led by Jim Rogers and George Soros, went up 4,200% in its first 10 years, which is remarkable. He retired at 37 after record profits for a number of years. He traveled the world. He broke a few records. He still holds the records of the most amount of countries traveled in a 12-month period on a dirt bike. And I think he did it in a Mercedes a few years later with his wife. After traveling the world for a number of years, he looked at the market and he set up his own commodities index when he realized that there was no easy way to invest in precious metals like gold or energy or food. His net worth is around 1.2 billion apparently. He's written a few books, some of them A Bull in China. There's Hot Commodities, Investment Biker Around the World, Jim Rogers. So he's written a number of books that are bestsellers. He's the go-to guy for commodities, especially gold. There he is. He's known for his bow tie. You've probably seen him on TV. Generally, when they're referring to gold or commodities, he's the main go-to guy around the world. This is what Jim Rogers got to say, right? I've told you my view. I've talked about where the economy's been over the last 10 years and why I'm concerned as to where we're going to go into the future. I don't expect the market to crash tomorrow. However, after a 10-year rally, it's hard to think it's going to continue in the same direction forever. And I think some of the other investment advisors in the world have started to think that way themselves, which is why we've got this current volatility in the marketplace. This is what Jim Rogers has said. If the world economy gets better, commodities are a very good place to be invested. Even if the world economy does not improve, commodities are still a fabulous place to be. Commodities have always gone up when a country is printing money, and every country is printing money right now. Investors should take precaution right now to protect their money from a major market disaster that will destroy the economy, probably millions of Americans. For the first time in recorded history, we have all major banks and central governments around the world printing huge amounts of cash. This has never happened in world history, and so the world is floating on an artificial ocean. You've got to pay the price someday, whether you like it or not. The longer you delay the day of reckoning, the worse the day of reckoning is going to be. This is not going to be fun. I'm not that extreme, right? But I do know that, hey, if Jim is right, if there is a GFC that's just around the corner, what do we need to do to protect ourselves? Also, in top of that is, well, what happens if a GFC doesn't happen? How do we protect ourselves and still provide stable investment returns? So the answer to that later question is still stay invested in growth assets, right? The JB way, some of the investments that we've got with the Berkshire Hathaway investment, they're aimed to get maximized returns on the upside, especially the JB way when we've got capital protection on the downside, protects us on the downside when the market falls, where our losses can be limited to maximum of 5 or 10%. However, the question of the first, if there is a GFC, how do I not just protect ourselves, how do we make a profit? That's really where I'm moving to now. Many of you would notice that over the last 6 to 12 months, I've becoming more and more conservative, moving from growth assets to fixed income with a global credit investment that we launched, now to gold as a defensive asset to profit on the downside. Let's look at gold as a defensive asset. So if there was a GFC, let's have a look at how gold has performed previously. Now, as I said before, past performance isn't always an indicator of future performance. But gold does have very different economic characteristics to growth assets. So I would imagine its perception as a safe haven, as a defensive asset, has not changed. And if global markets did have a fall for whatever reason, whether it's trade tension, whether it's political uncertainty, whether it's China, whether it's the United States, whether it's here in Australia, I do believe that my personal view is that the gold price will go up in the event that everything else goes down. The reason why I believe that is that's what's happened in the past. Let's have a look at the crisis. The oil crisis back in the 70s. for 12 months from May 1973 to May 1974. Just a 12-month period, gold went up 73.9% on the back of the oil crisis. 87 share market crash. 12-month period, oil went up 28.8%. Sorry, gold went up 28.8%. The GFC, for a 12-month period, gold went up 19.8%. Let's expand the GFC, because GFC wasn't just 12 months. Let's have a look at what happened over a 3-year period. So if we look there, if I get a pen out, I'll try to draw it. In this period from there to here, that's the GFC. The red line is the US share market. So GFC happened, the United States banking crisis occurred, and the American share market pretty much halved in value. So we can see gold price rallied over that period. For a 3-year period, let's see if we can do that. Erase that. How do I get back to my cursor? Oh. Three-year period from the high of the GFC to 3 years later, gold went up 127% over the 3 years. So for 12 months, it was up 19.8%, but for 3 years, it more than doubled. As people moved money, as people became more and more uncertain about the global economy, they moved it from growth assets being shares, property, to that of gold. So as we see there, historically, whether we go back to the 70s, 80s, or the GFC more recently, gold has performed very, very well when things get uncertain. If we go back to how gold has performed as an asset class for the last 100 years, it's been a good place to invest. As we can see, the J curve starts at the bottom of $19.20 and it's gone up to where we are now, just over $1,200 US an ounce, hitting almost $2,000 at its peak. More recently, how gold's traded. If we go to 2008, we saw the gold price more than double. As people realized that things weren't too bad, we've seen the shift again from gold or defensive assets into growth assets like the US share market, like shares more broadly across the world, to property. So that's generally what happens. When share markets and everything goes up, gold goes down. When everything gets uncertain and markets fall, even just by a small margin, gold goes up. We saw that in October. Global share markets fell, but gold started to increase in value. For us to get back to where we were in the high of 2011, just back to where we are, not talking about all-time highs, but just to get back to where we were at $18.94 an ounce, the gold price needs to go up 57%. So if we saw a bit of uncertainty, not even to the extent of a global financial crisis, it wouldn't take much for us to get back to those levels. So how do we get exposure to gold? There's a few ways for you to get exposure to gold. You can go out and buy the physical. You can go over to the Perth Mint and you can buy gold. The problem with that is that there's no leverage. So if you put 5% of your portfolio in gold and it doubles, you make 5% of your portfolio returns. If everything else falls 20%, you've still lost 15% on that scenario, even though you got 10% exposure to gold. You can look at buying an ETF, and that's how we're gaining exposure to gold. We're using GLD, which is traded on the New York Stock Exchange. GLD is an ETF, which I talked about before, an exchange-traded fund that is 99% tracking to the gold price. The benefit of it, though, is leverage. Tailored Investment Solutions, we incorporate our structure, which many of you would be familiar with Berkshire Hathaway, where we borrow 100% of the money, you prepay the interest, the hedging fee, and the advisor fee up front, which works out to be about 20% or 23% for a 3-year period. By having leverage, your 10%, if you allocate 10% of your SMSF portfolio to the Tailored Investment Solution gold investment, that'll actually give you 50% exposure. Your total self-managed fund, it'll give you 50% exposure to gold. So if gold doubled, you'd actually make a 50% return on your SMSF portfolio, which should more than absorb any losses that you experience in the other aspects of your fund if we had a GFC event. However, if gold didn't go up, your downside risk works out to be, 3.3% a year if you allocated 10%. So that's 10% for a 3-year period. So your loss would be 3.3% a year on your total portfolio. So it's not a huge loss because we've got a limited recourse loan. So you should get better returns from the rest of your growth portfolio in the event that the gold price doesn't rally. But if everything goes pear-shaped, the returns from gold by just having a small allocation like 10% should more than offset any losses and hopefully add to profits in your portfolio. And that's the biggest reason. I don't have slides on that, and I know I stumbled through those 2 points, but that's why I'm looking at investing in it. That's why I'm incorporating gold into my portfolio as a leveraged investment to magnify the returns if we do have a GFC event. But if we don't, my portfolio returns aren't going to be too negatively affected by having a 10% allocation to the portfolio where the losses is 3% a year. So GLD as a exposure, that's an exchange traded fund. It offers us an innovative, relatively cost-efficient, secure way to access gold. The management fee for the GLD ETF is 0.4% a year by SPDR, who are manager of the ETF index. It was originally listed in the New York Stock Exchange in November 2004, but it's now moved to the New York Stock Exchange in 2007. It's the most readily traded gold ETF in the market. Anyone that wants exposure to gold generally does it through GLD as an ETF. So the investment, Tailored Investment Solutions Gold Investment, offers you exposure to gold, which is through the GLD ETF. The reason we're looking at investing in it is because historically it's been the only non-correlated asset class to the other growth asset classes. Therefore, we incorporate it as a risk management tool for diversification, which is the theory of diversification as to what it was essentially created to do, but also as a profit maximizing tool because of the limited recourse loan and the leverage that's built into the investment. You borrow 100%, it's fixed at 4.95% per annum. That's a borrowing rate for 3 years. You've got to prepay that up front. There's a 2% currency hedging fee because we're going to invest in US dollars. You can borrow 100%, not just in your self-managed super fund, but in your own name. So it's not just limited to self-managed super fund investors, but you can get all the same investment characteristics outside of super as well. Quantified downside risk. Your downside risk is your outlay. It's not the leveraged amount. The limited recourse nature of the internal loan means the downside risk is quantified as the interest up front, the 4.95% times 3 years, plus the 2% currency hedging fee times 3 years. Every quarter you can sell out, but that's more of a profit-taking exercise. It is designed to be held to maturity, which is a 3-year term. Potential for yearly income distributions, that's up to 10% of the leveraged amount, which works out to be around 40% of your investment amount. Similar to your Berkshires that you might have invested in the other structured products that we've put together. So let's look at a hypothetical example. Let's say you want 100 grand exposure to gold. You buy 100,000 units at $1 for Tailored Investment Solutions investment. Your investment outlay, 4.95% plus the 2.2% hedging fee times 3. That works out to be $20,850. There's a advisor fee of $2,200, so your total outlay is $23,050 for a 3-year exposure to $100,000 worth of GLD investment. That is your risk. That is the maximum amount you can lose. It's $23,050. If gold does not go up at all at any anniversary, so in year 1 it's not up, year 2 it's not up, year 3 it's not up, you can lose 23 grand if you invest. If you want 100,000 units, 100,000 exposure to gold. It's not the minimum investment. Minimum investment's half of that, so 11.5 grand, which gives you $50,000 worth of exposure to GLD. There is no maximum. Key risks, look, if GLD doesn't go up, then you can lose that 23 grand, right? We need the underlying reference asset, in this case being GLD, the ETF. It's easily traded. You can look it up on Bloomberg. GLD is the code, and that'll give you the traded price. But if it doesn't go up, you can lose that 23 grand. There is no guarantee that there will be any coupons if there is no performance. The coupons, the income is capped at 10% a year. So if GLD goes up 20%, you get paid coupon in year 1 of 10%, the other 20% if it's up at the end of year 2 or year 3. There's no established markets for units. As I said, while we offer quarterly liquidity, it's designed to be held to maturity. The counterparty risk is an investment grade bank. Investment grade bank is a hedge counterparty. They're the leading banks in the world, like Merrill Lynch, Bank of America, UBS, Commerzbank in Germany, Citigroup, Societe Generale, to name a few. You should read the PDS for full description of the risks involved in the investment. Let's look at an example. Let's say the gold price goes down. So this is for the $100,000 investment. In fact, it doesn't make any difference the investment amount. We're talking in percentage terms. So let's say year one, it's down 20% GLD. Year two, it's down another 20%. Year three, it's down another 20%. So over 3 years, it's down 60. Maximum you can lose for a $100,000 investment is the $23,050. You get nothing. So you lose that 23 grand. That's where it's quantified downside risk. We know how much money we can lose. That is the maximum. Let's say year one, it goes down 20%. Year two, it's down 20%. Year three, it ends up 40%. Because it's up 40%, the value of the investment, the 100 grand, is now worth 140. I get paid a 10% performance fee. That's where I get paid. So I take 4 grand. You get paid $36,000. So $36,000 from a 23 grand outlay is a 56% return on your investment. It's a 56% profit. Let's say year one, it's up 20%. Year two, it's up another 20%. Year three, it falls, it plummets, right? You will get $18,000 in 2 payments. After year one, you get paid 9 grand. At the end of year two, you get paid 9 grand. So if your outlay is 23 grand, you'd get $18,000 back. So it'll be a 22% loss if that occurred. Let's say it goes up 20% in year one, 20% year two, 20% in year three, which is very similar to what's done in the events of a GFC. Not as much as what it went up in the GFC, but let's just assume it only goes up half of what gold went up in the GFC, which is a gain of 60%. You'd get paid $54,000. That'd be paid in 3 installments. The first coupon at 9 grand, the second coupon at 9 grand, and the final coupon at $36,000. Now, these assume the currency stays the same. Currency will impact these returns slightly depending on how the AUD and USD perform. The return on your investment, if the currency doesn't move, it goes up 20% a year. You make 134% profit. That's where it magnifies the return on the upside, which is why I like to incorporate a leverage structured investment over gold rather than just a straight investment in the physical. So how it paid, scenario one, if it went down year one, there'll be no coupon in year one, there'll be no coupon in year two, the final coupon will be 0, so your maximum loss will be your $23,050 outlay. Scenario two, where it fell in year one, fell in year two, and then went up 40% in year three, you'd get 36 grand as a final coupon, so you'd make a $12,950 profit, which is a 56% return. Scenario three, where it goes up year one, up year two, and then falls in year three to be down in value, you'd get paid 9 grand year one, 9 grand in year two, no value in the final coupon, so you'd lose $5,050 over the period, which is a loss of 22%. Scenario four, where it's up 20% year one, up 20% year two, up 20% year three, you'd get paid 9 grand as a coupon in year one, 9 grand as a coupon in year two. The final coupon will be $36,000, which will give you a profit of $30,950 on a $23,000 outlay, which is a return on your investment, a rate of return of 134%. Pretty cool. So that's where it's quantified. Your maximum risk is on the 23 grand. That's your outlay, but you get the upside growth on the leveraged amount. That's where structured investments can be a very powerful investment tool, where internally we implement capital protection and leverage. So you get all the upside of leverage without the double-edged sword on the downside, provided you make a return above the cost of the investment, which is the $23,000 outlay. So if the gold price went from where we are today back to the previous highs, post GFC, to where we were 1894, so just back to those highs, we're not talking about creating a new level. The index, the GLD would need to be up 57%. So if we looked at that 100,000 example, your investment outlay would be 23 grand. Your return over the 3-year period, depending on how it got there, would be $51,660, which is a return on investment of 124%. So if we look at a hedge against everything else falling, this investment offers us the most powerful hedge than anything I've seen, because of the leveraged nature and exposure to gold through the GLD index. That's why I'm incorporating just a small part of my portfolio. Of course, of the leverage component, if a GFC event happens, my return on this investment, if gold did go up when everything else fell like it has done historically, the returns should be extremely high, which will not just offset losses elsewhere, but ensure my total SMSF portfolio returns are positive. And I think that's our job as as investment managers. That's our job of self-managed super fund trustees, is to not just reduce risk when markets fall, but also how to profit in those times as well, which is why we only want a small portion of our portfolio exposed to this investment. So we looked at modern SMSF portfolio in theory. I think the majority of us need some form of exposure to gold as a hedge, just in case all of the market news, all of the headlines, UBS talking about a 30% property fall here in Australia, talking about rising interest rates, trade tension, political drama, inflationary concerns, China, the United States, or here in Australia. There's a lot of things to be worried about. And generally I'd say, hey, don't read the newspaper. If you are reading the newspaper, read the sports section, not the business section. But right now there is a few things that we need to be concerned about. And why I'm becoming more and more concerned and why I'm looking at those headlines is that we've been 10 years in a very strong bull market in the United States, and that's the largest economy in the world. So it's time to hedge our bets just in case things do fall. I think the Tailored Investment Solutions leveraged exposure to gold allows us to have a small portion of our portfolio to mitigate risk, but also to potentially provide portfolio returns. I think that's why I've called it the modern SMSF portfolio theory, because those other four asset classes are correlated with the small world economy that we now live in, and underpinning all of them is debt. If we have a debt issue like we had in the GFC, all of those will plummet. Gold does not have debt underpinning it, so it should be perceived as a safe haven, not just in the short term, but the foreseeable future. So look, we need a product disclosure statement. We've got one dated the 29th of October. That gives you all the details about the investment. If you want a product disclosure statement, if you want the application form, email me, email your SMSF Club advisor, and or put your details in the question section. I haven't looked at the question section. Sorry about that, but I'll get to that in a moment. Send me your details, and we'll send you more information on the investment. If you want to speak to your advisor, email your advisor to organise a time to discuss it. The investment closes the 15th of December, so you've got a little bit of time, but it's not a long period. So we do need your investment money by that date. The investment will take place on the 15th of December. So it's a closed-end investment. We put it all together. We raise the money. We move forward. Let's get to questions. I'm sorry if I've asked any questions. In fact, there's no questions in there at all. Not too sure if questions is working or if you've been hearing me. I hope so. If you've got a question, by all means, now is a time to ask. What's the minimum investment? The minimum investment is $11,500. That's a cash outlay of the minimum investment. That'll provide you 50 grand exposure. There is no maximum investment amount. How does this investment compare with the JB way? Well, if you've got your protected shares, that's great, because if you had the GFC event, your losses wouldn't be 30, 40, 50% that we experienced in the GFC. It should be around 5%. And then if you made huge gains in the gold investment, if gold performed the way it did in the GFC, then you would make very, very healthy returns. Unfortunately, one thing that I've learned is to have exposure to gold during these adverse times. Go back pre-GFC, I didn't have gold as a part of my portfolio. So I did lose money, but because the majority of my portfolio was protected, those losses were minimal. So I invested via the JB way. And I suppose one of my lessons is that had I had exposure to gold during that period, I wouldn't have lost money. I would have made a very good return. On what basis is gold a safe haven? Why might it no longer be safe? I'm not too sure. I think the reason that it's a safe haven is because there's no debt. Gold historically has been perceived as a safe haven because banks have had to hold it, governments have had to hold it. That's not essentially the case anymore, where banks and governments hold gold for their debt that they've got. But of course, there is no debt under gold. It's perceived as a safe haven as demand for gold increases in the times that people move it from riskier assets, being term deposits, property, and shares. They go to gold because it's secure. They know what they're getting. Hi, Justin. What is the smallest amount that can be invested? Again, so that's $11,500. I think it is. And that gives you $50,000 worth of exposure to the Tailored Investment Solutions GLD investment. Should I be selling my Berkshire Hathaway investment? No, don't sell Berkshire Hathaway investment. You still want to be exposed to growth assets for the lion's share of your investment. Berkshire Hathaway has been a phenomenal investment. In fact, Warren Buffett just came out and announced that over the last quarter, Berkshire Hathaway bought $1 billion worth of Berkshire Hathaway shares. So it's got a lot of money sitting in cash, and they could deploy it anywhere in the world, and they're choosing to buy Berkshire. So I don't think Berkshire is going to have a pullback anytime soon when Buffett's buying his stock. And it's been up over the last 2 weeks. Since Buffett came out, that announcement went from around $205 a B class share to 220. So it's gone up. So I wouldn't be selling out of anything in the growth assets, but it's very important to ensure that you've got protection on the lion's share of it. Berkshire is leveraged, so with leverage that's similar to this gold investment, if Berkshire doesn't go up, you can lose your original investment amount. For the majority of investors, they've got a coupon which is being paid into bank accounts, which is already harvest some of the growth along the way. We do have another Berkshire Hathaway investment that is open. It closes on the same date. So if you want exposure to Berkshire, if you love the performance of Berkshire in the past, it is open for new investors right now. It's the same terms, it's exactly the same structure as the gold investment we've talked about tonight. It's just the underlying asset is Berkshire Hathaway B-class shares as opposed to GLD. If this TIS is for a GFC, then what is it likely to do if the market stays stable or grows? Look, good question. As Jim Rogers said, is that commodities is generally a good place to be invested. I think the timing of it, look, I've been looking at gold for the last 6 to 12 months. We've seen the gold price sort of create a sort of stable base from a technical analysis perspective, so I don't think it's going to fall much further. So I do think it's a good place to invest, even if the other equity markets go up. But again, if everything goes up like it has for the last 10 years, and let's say the last 5 years, gold price continues in that direction, gold price falls, that is probable, right? There is a chance of that, or possible, there is a chance of that occurring. So you just have to be prepared for that, because whatever you outlay, your 20 grand or 40 grand or 11 grand, whatever it is, for your 100 grand, if you want more exposure, you got to be prepared for the worst case scenario. And the worst case scenario is if it doesn't go up, you can lose that investment amount. So just be conscious of that. I'm not talking about putting a huge amount of everyone's money into this. Just talking about if you are considering a small allocation is ideal. Can you take this up in your personal name outside of a self-managed super fund? Yes, you can. And the good thing about it is whether it's in a self-managed super fund or your own name, it's a limited recourse loan. There's no recourse back on you as an individual for anything other than the upfront amount. So, look, a lot of people are becoming more and more so, especially in our Berkshire Hathaway investments. They've invested in that in their super fund initially, and it's provided them a great return over the first investment term, and then they go, oh, I didn't realize I could invest in my own name as well, and they're looking at investing in it as well. A lot of people are investing in both their self-managed super fund and individual names. That's not just Berkshire, that is this investment as well. So it's a good hedge, not just in super, but also in your own name. So look, I've gone for a bit longer than the dedicated hour. I've hoped you've learned something. If you look back at the key statistics and SMSF modern portfolio theory, I think we all need to look at allocating something and be prepared for a correction. Every 10 to 12 years, there is a correction in the market. Sometimes it's shorter, sometimes it's longer, but on average it is around 10 years. And we're 10 years into that bull market in the United States, so I think it is the time to be precautionary. I'm not like Henry Dent, where every year I talk a negative story to get headlines. I haven't said that the market was going to have a pullback in the last decade. Been very optimistic in the global economic growth. Now I'm becoming cautiously optimistic. I think over the long 10, 20-year period, global share markets with Australia and the United States, property markets going to be a lot higher than where we are today. But in the short to medium term, the next 3 to 5 years, there's going to be turmoil. The market's going up and down. I think it'd be silly not to have a portion of your portfolio in gold as a defensive asset. So look, there's a few other questions there. I'm not going to get to them. I'll come back to you via email. Thank you for tuning in. Look, like always, an investment knowledge pays the highest interest, but only if that is applied. You need to do something about it. If you've got money sitting in cash, start looking at your alternatives to deploying that. Consider risk management. Consider the potential returns. As I said, if you've got a huge amount in cash, that is the riskiest asset class you can hold. By all means, you do need it for cash flow. If you've got any debt, especially on property to meet interest obligations, insurances, accounting fees, I think you're all paid up till July next year, so you don't have to worry about paying me for a while. So consider cash flow requirements, but also consider that you've got income coming into your fund. So if you do anything following this presentation, as I put it to you earlier on, look at your money in your bank account and see how much money you need, calculate how much money you need in cash for cash flow requirements over the next 6 to 12 months, and then ask yourself how you can invest that to provide a better return than the 1% you're earning in the bank account. So thanks very much for tuning in. Again, I respect and applaud you all for taking time out of your busy schedule. Good night and happy investing.